So welcome back to Wook Capital Management's 49th edition of our weekly Wook and Review broadcast series. I'm Managing Director Rod Alsman. Before we get things started here, Joe, if you could just read our little disclaimer, and then we'll dive right in.
No problem. So, Wook Capital Management, Inc. and its employees solely provide investment advisory services to family clients and do not provide investment advisory services to the general public. Furthermore, investments are highly speculative in nature and involve substantial risk of loss. We encourage investors to obtain advice from a professional investment advisor and to make independent investigations before acting on information that we publish. We cannot assure you that the information is accurate or complete. We do not in any way warrant or guarantee the success of any action you take in reliance on our statements or recommendations. Past performance is not necessarily indicative of future results. All investment decisions of an individual remain the specific responsibility of that individual.
Need you to just make a recording of that so we can just play that at the beginning. All right, well, with that legalese out of the way, thanks everybody for spending some time out of your Friday afternoon with us. Going to walk through the material that Joe shared in the newsletter that went out this morning that I have on my screen that, Joe, if you can pin the thread, please, to the channel here for anyone who hasn't seen it yet. I'm going to talk briefly about GameStop, freight markets, labor markets, and then we can kind of open it up for just about whatever. So quick on the prepared discussion stuff. And yeah, let's, Joe, kind of go from topic to topic. If people in the audience want to request to speak, please feel free. If you're on Discord, I can't hear your audio. You can hear my audio. Please use the Stages chat feature, and I'm looking at the chat. So I'm also looking at the Spaces chat. So I'll do my best to answer any questions as they come. So yeah, we'll start off with GameStop. They had their second quarter earnings results released this week. All that we got as investors or as market participants is a 10Q filing and a very brief 8K for the press release. So I guess I'll bring up on my screen here, I have a little Koyfin screen template, whatever you want to call it, that I had put together at some point in prior quarters. I called it GME turnaround. Basically, it's looking at a few different metrics. I'm looking at cash conversion cycle, inventory turnover, and then some just basic financial metrics like revenue, gross profit, SG&A, just to kind of see what the business trend looks like, especially for a cyclical company, a seasonal company like GameStop. Looking at individual quarters, you might not get the full picture. You probably need to look at it on a year-over-year basis. You shouldn't look at it on a quarter-over-quarter basis. It's not going to give you great information. Looking at it on a last 12-month basis, at least, will smooth out that variance. So I have these data points on the screen here, and I'll get my head out of the way. Let me not put the screen blank. Get my head out of the way. You can see, so I'll kind of make them a little small, but you see cash conversion cycle is unfortunately trended in the wrong direction, which is not good in terms of how efficiently they're using their working capital. Good data point is the inventory turnover continues to improve. I'm looking at the last 5 years, and we zoom out to the last 10. You can see that they've actually made some great strides on inventory turnover over the last year or so. Kind of that number is now at a 6.3 times. It had gotten all the way down to 4.1 at its trough about a year ago. So inventory turns are improving. They're selling more throughout intra-quarter. Profit margins are still pretty light though. So they on the high level. Well, let me just pull up the Q. We kind of look at the Q and go through it briefly. At the high level income statement, as you can see, we're talking about a gross profit of, I think, what was it, 26 and change percent. They have a, thought they had a slide here. maybe it's not in the queue itself where they broke out the percentages on it, easy to see. Let me go back to the 8K. Apologies there. There we go. All right. So you can see this just has the income statement items at the top, and then the percent of net sales just to easily see at the bottom. So gross profit up 150 basis points year over year. So they got some lift there, even though on a mix standpoint they had headwinds from mix. By that I mean they had less of a contribution from collectibles, which is a higher margin segment. They don't break out pre-owned explicitly anymore. They haven't done that for several years now. They did call out though in the queue, excuse me, that the decrease in net sales year to date was primarily attributable to a decline in collectibles sales and a decline in sales of pre-owned hardware and software. So that's the only mention of pre-owned in the entire document. Again, they don't file, or excuse me, they don't hold an earnings call anymore. They don't have a CEO anymore. They have a general manager. But look, it's progress. It was a better result than the few remaining sell-side analysts that cover the company had expected. So it was a slight earnings beat, and on the at least adjusted EBITDA line that they opted to report, it was a positive number, which was positive 1 million relative to, obviously that's them opting to add back stock-based comp, which was $9 million in the quarter. So look, EBITDA's a fuzzy number, but at least relative to what was expected, they did better on cost containment. And going back to that kind of Koyfin graphic here, looking at SG&A, again, this is a trailing 12-month SG&A going back 10 years. You can see that they've really taken a lot of cost out of the model in the last year. They've reduced SG&A. The year-over-year run rate is down from like 1.7 to 1.45 billion. So a pretty nice improvement. The challenge, unfortunately, inevitably comes back to, it's great that they're taking cost out of their model. It's great they had a solid result helped by the tailwind of the latest Zelda release intra-quarter, which they didn't explicitly call out the game, but they did note in the queue. And it's nice to see that it looks like there's a chance. So you're telling me there's a chance that they could get to a positive EPS for the full year. That's all well and good. I think the challenge simply remains what is kind of the steady state cash generating capabilities of the business. And it's still unclear to me how you get from where they are now, right? You can only cut costs so much, and they've leaned a lot on kind of reducing, they've actually taken, I think, store hours down a little bit. They're closing a little bit earlier, I saw in some of the employee Reddit discussions. They have very limited kind of employee coverage in the store. A lot of the stores have like one employee at any particular time. I'll try to dovetail this with retail because there was a few interesting articles I saw today about kind of the retail space. Bloomberg's Big Take was talking about retail, kind of talking about increased turnover in the retail space. So the data point I think I saw was for at least part-timers, which, for companies like GameStop, a lot of their employee base in the stores is part-time. They don't want to have them work over 30 hours, at least in the United States, because if they're not a full-time employee, they don't have to offer them different employee benefits, healthcare coverage that are incremental cost for the employer. So I saw that data point from Bloomberg's Big Take talked about part-time employee turnover had risen from pre-pandemic levels in retail writ large from 75% turnover rate to 95%. So turnover's up. Definitely retail employees broadly not feeling so great about life in general. There was a data point out of Walmart earlier this week. It was yesterday. thought it was earlier in the week, where Walmart has recently changed its wage structure for hourly workers, and they are reducing the starting pay. So I thought that was a pretty big deal. It kind of goes in line with this theme that's been happening for most of the last 6+ months of the ongoing softening of labor markets. That, yeah, we're seeing, Walmart now having most new hires earning the lowest possible hourly wage for the store, and that wage structure, is a change from the tight labor market of 2022 and 2021. So continued loosening in labor markets. Trying to dovetail that with GME. Yeah, I mean, the quote that Joe lifted is that the results show encouraging signs towards their ongoing transformation plans to regain their presence in the video game retail industry under its new leadership. But yeah, it's just still unclear. There needs to be some incremental gross profit that comes in to justify something near the current valuations. But Joe, I'll pause there. What do you think about GameStop's results, or anyone in the audience who wants to chime in?
I mean, people were excited at first. I mean, it was up 6% after hours, and then quickly fell back down. I think the SEC probe is what held it down today. And yeah, I mean, Ron and I, we were both involved in SEC related investigation or SEC investigations related to GameStop, and we kind of understand that it doesn't necessarily mean there was any wrongdoing in any sort of way. It just means that maybe someone tapped on the SEC's shoulder and said, "Take a look at this."
The stock was down 6.3% today. Still trading at $5.4 billion market cap. My question is still, when will the positive cash flows that justify that valuation come in the door? And I just don't see where we get to that point. But clearly their Web3 related initiatives they've pulled back from markedly. We highlighted the cost takeouts. It's just there's only so much meat you can cut until you're cutting bone, and eventually the lift needs to come from incremental revenues that are going to flow through on that lower cost base. And given how weak the collectibles space has been for them for some time now, and kind of the lack of any progress, it seems, in like Web3 stuff, crypto stuff, I'm just not sure where it comes from. But clearly there's still a lot of folks very excited. I did see that the direct registered share count number declined quarter over quarter by 1.2 million shares. So some people are selling who had perhaps previously done the direct registration, but yeah, it's nonetheless a fascinating thing, and we keep talking about it because we wouldn't be here today were it not for the investments that myself and Joe and John and the team made in the company before the mania. So it's still just fascinating to follow. Any other thoughts on GME before I move on? Not seeing any requests, so I'll keep moving to freight, and we can circle back when we open it up in a few minutes here at the end. Freight market, you guys hear me talk about this a lot. It's a space I know pretty well, so I feel more confident talking and speaking to it. We're at a point where Freight Waves, who Craig Fuller's business, I don't know what year it was they started the firm. It was less than a decade ago, but this is a guy who was raised in the transport industry. He's in Chattanooga, Tennessee, which is a big transport city and hub. FreightWaves as a business is kind of in the data and market information space and news space. So I follow what Craig has to say. I had a chance to speak with him when I was at Ryder. I think he has a pretty good pulse on things, and I think they at FreightWaves have the best data on these things. So the graphic that was included in the newsletter uh, is what's called the outbound tender rejection index. So when a shipper is going down its list of carriers to haul freight, and it sends that tender to its top of the routing guide carrier, and that carrier rejects it, the implication there is that if rejections are happening, that carrier has better alternatives elsewhere, perhaps in the spot market. Kind of all else equal, it's a useful indicator for the relative tightness or looseness in the truck transportation market in at least North America and the United States. Uh, Outbound tender rejections, as seen in this graphic that Craig had shared in his write-up, I think it was earlier this week, last week, you see it reached the absolute bottom in mid-May. It made another kind of couple low points, very low levels of tender rejection, below 3% in both June as well as again in mid-July. But it's been on an uptick over the last month or so, and FreightWaves feels confident in calling a bottom. Which, what does a bottom mean? It doesn't necessarily mean that prices of both the equities and of uh, contract freight don't go lower. What it means is that we're kind of at that clearing level where the rationalization of capacity, that's something I've talked about a few times on these different spaces calls, that was a must have. Let me pull up, I don't think you included the link. Let me find it in my notes. Yeah, he had included this graphic here, which, oops, is carrier net. So it's trucking authorities. So you can see the net changes in trucking authorities. This is FMCSA data, and there was just this massive green in late 2020 through the balance of 21 and even into the beginning of 22, where there were just everybody and anybody thought they could make a buck in freight, and they could. It was one of the most incredible, once in a century events. You had a massive expansion of goods demand relative to supply, and it led to a hell of a lot of freight. So people could make money. Freight rates rose as the market cooled. Right, all of that excess capacity is still getting soaked up. So even if it's getting into better balance and the bottom is in, as Mr. Fuller argues, that doesn't mean that it won't continue to be a bad environment for fleets of different sizes. Like, just because it's maybe the worst is behind us doesn't mean that the current operating environment is good. It's going to be a couple more quarters, I think, into 24 before you really get spot rates tightening up. Although, as he called out, just this week, and he made a very good point. I remember at Ryder in 2017 when there was a hurricane that really messed up Texas. There was a lot of flooding, and it was like when those hurricanes hit in 2017, that really started sending things in the freight market up in the summer of 17. And then, of course, once you got the what do you want to call it, Tax Cuts and Jobs Act, that also led to this massive uptick in kind of freight fleet replacement, on new equipment, yada yada. And you had a little boom bust, and then you had a freight recession into 2019 that really was long in the tooth when COVID hit. And freight markets are not the whole economy. It's just a portion of the economy. There are more freight recessions than there are real kind of macro recessions. But just kind of looking at the freight market, it's been in recession now for over a year, and Craig's not the only one calling for kind of a bottom. You can see kind of this is a truckload line haul index at the national level. Remember, freight's always going to get priced uniquely. If you're in a one-off lane, moving freight from, I don't know, from BFE to somewhere else, you're going to have a different rate than if you're moving in a main lane, say from like LA to Dallas or Atlanta or something where there's a lot of volume kind of going through that I-10 corridor out of the ports. So, this is a national index. FreightWaves gathers. You can see that uh, again, May was when the rates troughed, and look at these rates. We're talking about $1.60 per mile. These are rates that are not even covering the operating costs for a lot of the fleets that are running them. So you get you get this situation on the backside of these boom bust cycles in freight because there's not really any barrier to entry for truckload freight. You just need a CDL and a tractor to haul freight. You don't need too much more else than that. All of these new entrants came into the market, flooded the market, and took advantage of the high rates. And now for some time we've had this bleeding. A lot of carriers' balance sheets, though, were strengthened markedly from COVID, and the smaller carriers, will hold on. They don't want to go bankrupt, but unfortunately, when your rates are $1.60 per mile, your operating costs are likely in excess of that. So another good resource is CAS. So the CAS Transportation Index comes out once a month. The latest report was July. I'm just going to pull that one up to show a couple kind of graphics. You can see that, depending on the time horizon you're looking at, shipments are actually down a lot. Nominal shipment volumes are down quite a bit. They're back to kind of that recessionary level of late kind of 2019, at least from CAS's database, which CAS provides like tens of billions of. I know that it's coming from tens of billions of dollars worth of freight moved through their network, but this graphic here is kind of the wild one, is the CAS freight expenditures. So you can see this incredible increase in the freight expenditures index from the COVID trough through to kind of the peak in mid 22. And now we've come back a lot, but we're still very elevated from where freight rates were broadly before COVID. So it all depends. There's all these little niches of spot freight, contract freight, yada yada. But I would agree with Craig's assertion that the bottom is in, but there's still a lot of capacity that still needs to get rationalized. Read truckers that need to turn their keys over, or sell the truck, or that are going to go out of business because they just don't have the balance sheet to support it. The smaller truckers in particular. Line haul freight rates are still, we're talking about levels that were the prior peak in, say, that kind of boom time I was referring to in 2018, which are again down, big time from 2022 levels. So it's all, where you're talking about, what your cost structure is. And the big truckload carriers, they can absorb, a weak freight environment. A lot of them are not touching spot freight. They're dealing mostly with contractual freight. But freight is, when we say contractual freight, it's not like a true contract. We agreed that we'll run at this price in these lanes, for a 1-year term. And unless it's truly dedicated capacity or dedicated contract carriage, which is a different thing altogether, then it's not really contractual, although they call it contract rate, because those rates do kind of inform what people are paying. And spot rate is what, like the name implies, where people could just go out and find a truck for. Right now, there's a huge spread where spot rates are far below contract rates. So now seeing that tightening in the rejections implies that that with the capacity rationalization that's been going on, it's getting tighter. It's no longer the worst, but there's still, as I said, I think a couple quarters left of pain. So we'll see. One of the big factors to watch for, I think, as the OEMs open up their 2024 order books, so as Daimler Truck, as Volvo, as PACCAR, which of course owns Peterbilt and Kenworth, and DAF for our European friends, as they open up their 2024 order books, look in the in a month or two here for their third quarter commentary on what they're seeing. You can also look at transport topics. ttnews.com is a good free website that has a lot of reporters who cover the industry. Around it should be in early next week is when kind of these data points come out on a monthly basis. So you'll get commentary. They'll lift a quote. They'll ask the ACT Research. They'll ask SFTR Transportation, who's another big player in kind of forecasting for the space. What they're seeing, and yeah, I would say stay abreast of the ordering. If we start to see a big fall off in ordering, then that would definitely tell us that expectations are dimming, perhaps for what 24 is going to look like. But yeah, so that's freight. I went and covered a lot of stuff there. If anyone wants to ask any questions or talk about it, otherwise, yeah, I already mentioned the Walmart thing. So, and then the last data point or last story that I want to mention was just another one of those cost items for employers out there. This was a story Wall Street Journal had out earlier in the week talking about employer healthcare coverage. Again, dovetailing all the way back to the discussion about retail, where they, don't want these workers working over 30 hours because they don't want to have to pay for their healthcare. Willis Towers Watson and Mercer are calling for the cost of employer healthcare coverage to rise 6.5% in 2024. So, pretty large increases, and that is a cost that's already averaging almost $15,000 a year per employee. So, the employers will probably eat a big chunk of that cost, like they usually do. But while there's disinflationary trends throughout certain pockets of the economy, right? There's clearly still inflationary trends in others, and this is just one I think worth calling out. And one last thing I didn't see in the newsletter, but I did see both of them put it out this week, was that both UPS and FedEx on kind of the parcel side had come out with their general rate increases for 24. The UPS increase came on the heels of the FedEx increase, which they matched FedEx. If you remember a few months ago, right, they came to an agreement with Teamsters, and there was some pretty big cost increases in the UPS labor model. So here I'm looking at a FreightWave story I have up. FedEx had put out a 5.9% for their kind of general tariff rates, which is a lower rate of change than the prior year. But at least in UPS's case, the first year of that labor contract is expected to raise costs by as much as 9% year over year. So if they're only taking rate 5.9%, then at the bare minimum in year one of this, you're going to see margin compression for UPS as a result of this. And of course, remember the two run very different operating models, where FedEx in the ground network uses independent contractors. UPS owns and operates its last mile network, which they have the direct relationship with labor that FedEx does not. They have, I think, historically been a better operator with the owned and operated than FedEx has been with the ground. But FedEx, not to go into the weeds, we know that they are working on integrating their ground and express networks to try and reduce cost from their network. But I think the main call out with regard to the big parcels are costs are rising, and it appears that costs are going to rise, at least labor costs, in this case for UPS, faster than they are taking rate. So this has been a big, to me, this is a big theme of margins. Corporate margins had reached extraordinarily high levels. Now, can they remain at those levels, or will they compress? And it, at least in this one slice of the world, looks like margins will compress. So that's all I had prepared. We can talk about whatever folks want to talk about for the balance of the time. Any questions, comments, take us on a different tangent, or talk about what we talked, on the topics we talked about. But yeah, I'll pause there. And if anyone wants to request, please feel free.
I'll invite up some of our usual crew.
Question for you guys, because you guys are way more, in tune with the macro side of things than I am, because I'm more of a micro guy. But why do you think, this period of inflation has developed, or as so when I think about performance of certain companies, if you looked at historical data, you would think that something like Dollar General or British American Tobacco would be kind of outperforming in this environment, like it did in like the 70s or in the early 2000s. So what do you think is going on here? Because we've seen the lower wage consumer be more impacted by inflation than, I guess, higher earners. But it feels kind of weird. So I was just wondering if any of you guys had any opinions on that, or maybe that's a stupid question.
I wouldn't call us macro. I please don't ever disrespect. Just kidding. It's not. I just don't ever want to be known as a macro guy. So
No. You
it
guys
hurt
are
me to
no. I
hear
was
that.
saying you were more macro aware, right? Because you're in a PM seat,
I'm kidding. I'm
right?
kidding. Yes. Look, I mean, we can all right. We can all look at the same data and come to different conclusions. But I would agree with what you just said. That yeah, clearly the bite for lower income is at least as I see it, we've observed that. I mean, I still just think a lot of this is a lot of bullwhips that have just a lot of like head fakes that have just got a lot of us. I have to think like everybody's gotten something wrong in the last couple of years in terms of thinking that extraordinarily high levels of e-commerce activity are the new normal. Well, sure, e-commerce mix of total retail sales is likely going to continue to grow, but it looks like we've kind of gone back to maybe what the pre-COVID trend would have implied we'd be looking like, as opposed to some like material step function change in how we live our lives. Um, I saw you commenting about like Dollar General. Like it's really hard to disrupt a business like that with e-commerce because that lower income consumer, who may not have the capacity to buy a Prime membership, which is not cheap, depending on I guess how you value it. Uh, these are very, these are low margin products that cost a lot. Like freight is a larger mix of the product value. So like to get that to your door, I just don't see Dollar General at as much risk as maybe some other retailers. But I mean, yeah, if the lower income consumer simply has fewer dollars, fewer real dollars, and fewer discretionary dollars, I mean, it's painful. I don't remember what the question specifically was, if I'm kind of addressing it or not.
It was, do you think this dynamic changes, right? So, the title here says Walmart cuts pay. So, in theory,
No, that's not really what they did, Joe.
um,
Yeah, I just
Sorry,
needed
not
it to
talking
be
to
a
you.
little shorter so it would fit. I'll edit it, but yeah, it just needed to fit in the title.
Okay, gotcha. I was thinking I was getting screwed even more here. I was like, the volume's already going down 9%. What if they went down 11%? Because I'm looking at the price of cigarettes just in New York. When I was living in Redacted, cost of a pack of cigarettes was like $8. New York just imposed a new tax. It's $18.95 for a pack of Marlboro Lights here. Like, that is insane to me. That
Seems like there are more cost-effective ways to get your nicotine.
yeah. Well, $6.95 is a can of Zins. So, but holy crap, man. So, what do you think is going on? Like, how do you think that this situation rectifies itself? Or is that like above your pay grade?
I mean, my answer would be that corporate margins come down, and they they're going to run out of room to keep taking, like, not the Dollar General fits this category. This would be more like maybe the Procter and Gamble's kind of staples of the world that have, as you're I'm sure aware, taken a lot of price in the preceding year or two. Volumes have been down or flat for a lot of these staples companies, and they've taken a lot of price. And I think they're long in the tooth on their capacity to take price broadly. And I think that means that, as kind of the discussion on UPS on the logistics side, that means that margins need to be compressed unless they're through the power of AI taking meaningful costs out elsewhere, which I'm still not sure when and how that all comes into fruition. But the market prognosticators certainly think that corporate margins will remain healthy and that corporate profits will continue to grow. I do kind of question, as in aggregate, the consumer's excess savings appears to be gone, and some consumers face incremental kind of headwinds in the near term as the labor market keeps loosening. That these companies are going to find it challenging. P&G, I don't think they're going to be able to take price at a high single-digit clip, across their brands, as maybe they were able to a year ago. And I think they'll probably see more. You're going to probably see continued like shrinkflation, right? Like reduce the ounces or whatever measure of the product, but maybe price stays flat. But of course, you're paying more on a unit basis. There's the packaging stuff is magical that they can pull off with that. But yeah, I mean, it's not a great thing, right? Because it implies like stagflationary kind of environment, I guess, more than anything else. Yeah, I don't know.
Appreciate the answer.
Yeah, here's a graphic. Again, I don't think anyone's live in the Discord right now, but for anyone watching this replay, Fidelity had sent one of their little viewpoints emails, and I liked this graphic because they layered a 10-year view of price to book, price to cash flow, EV to EBITDA, and next 12-month P to E. So you can kind of see all of those four in one place using FactSet data, and it just kind of highlights that really, other than kind of the post-COVID mania. The S&P 500 is richer than it's been at any point in the preceding decade, and it wasn't really cheap in 2019. So I don't know. I don't think forward returns for domestic equities are going to be as robust as people would like, and as I'm sure you're aware, the spread between the large and the small is just so extraordinary to me. I continue to question, like, is this the new normal, because passive has just overwhelmed everything, that people will just keep piling into these more and more stretched. But anytime you get a new normal notion, I feel like it's probably best to disavow that and assume a reversion to the mean takes place. And maybe this time it's different, but I'm inclined to think no.
Yeah, no, I would tend to agree with you. But how does the passive unwind happen, right? Because people in their 401ks are just effectively buying an S&P 500 index fund, and that's indiscriminately buying, the biggest names. It's market cap weighted. So how does that unwind?
Well, I guess there's two ways. One way is, well, if those people are no longer contributing to their 401ks because they're unemployed, and then the likelihood of their need to tap those 401ks, whether early and paying the penalty or whatever, that that recessionary type environment, that would be one. I mean, that's not a structural thing. That would just be a cyclical thing. But there's that. And then I guess a more structural one would be someday into the future, the demographics, I guess, dependent on how many immigrants we allow to continue to come into this country, unless we all start having a lot more sexual relations and children, that you're going to have a lot more people that are drawing down rather than contributing. But that's a years out thing. So I mean, the only answer would be that if we really start to see the labor market deteriorate and there are fewer people contributing and more people taking out, and that's not a structural thing. But that's my stupid take.
Gotcha. No, that makes sense.
I was looking at Steve Sosnick, the Interactive Brokers chief strategist note he sent out this morning, and so he was kind of calling out. So his headline for the note was "Worshipping at the Mega Cap Altar." He had a few equal weight versus just cap weighted. So you've got a pretty big spread that widened. It only happened after the banking crisis. So it had to have been the notion, and he says it's not an original thought from me, but the notion that these businesses are so wonderful that they deserve to be bought above all else. And really from early March onward, there's been a big spread between equal weight and cap weighted. And it's not just the wonderfulness of the businesses. He also calls out, of course, the AI enthusiasm piece, which makes sense to me, although that spread didn't really widen. It didn't really open up at all until after the banking crisis. So I don't know that that's as much the driver as it is what he says, quote, "There is a consensus among many investors that the largest stocks have relatively bulletproof earnings power. Many of them certainly have competitive moats, ... So, yeah. I mean, I'm still short some of the mega caps personally in my personal account, but we'll see. Maybe it's different this time.
Yeah, it's just they are phenomenal businesses, right?
Yeah, but what's the right price to pay if you have a business that's trading at close to a 30 times earnings multiple and is only growing at a single digit rate? Like I don't see how you get a good return,
No, for sure.
especially in the context of where risk-free rates are. But does it even matter? I guess if again, if you're being compared to the index, it seems like we're at that point where late in this cycle, a lot of professional fund managers would rather just own those, knowing they're less likely to be fired than sticking their neck out on stuff that maybe is more, maybe there's more perceived riskiness, even though I would argue it's actually the inverse. There's, if the price is lower or if the valuation is lower, all else equal, there's probably less riskiness. But
Correct. I agree with you.
the professional fund management world doesn't care about that stuff. Incentives are kind of perverse sometimes.
No, for sure.
I mean, wasn't there news today of Google thinking about like renegotiating their $20 billion deal with Apple for the search, like the default search like position? They have
Hadn't
like a
seen it.
deal to
The TAC or whatever it's called.
yeah. That's like a fifth of Apple's profits
Yeah.
is just Google revenue.
Can you link that?
Let me
I'm not
find
seeing
it.
it.
I saw it earlier today. Maybe I can check my likes.
My whole thesis with how, you would get the unwind in, some of these mega cap names was essentially that just like .com, you had essentially like layers upon layers. So like startups would use, Microsoft, and that's why Microsoft would grow, and like like layers, right? So I thought that, if venture capital funding dried up, that would start like a chain reaction, and that would eventually hit Google, right? So there was this Chamath, which, he's a grifter, but um, forget what
Hey
the
man, he's in the arena.
yeah, he's in the arena trying things. Some will work, some won't. But the one he did say one thing that was smart, like a few years ago in his letter. I think he said 40 cents of every VC dollar is spent on Google, Amazon, and Facebook, or something like that. It was some stat like that. Um, so if you think that venture capital funding dries up, then eventually that has to hit, where these companies are spending their dollars, right? These startups are spending their dollars. But I guess that isn't
Yeah,
happening.
I just posted the tweet in the comments of this space. I can't pin it, I think, to the space. I don't know how to do that. So sorry.
No problem. I'll pin it.
Yeah, I think this has been discussed a little bit, but like with Huawei coming back in China, like Apple got a huge boost in market share from Huawei being banned, right? They couldn't get the 5G chips anymore from Qualcomm. So from 2020, right, there was COVID, right, which helped Apple, but like also, their market share in China jumped like crazy because, people
Yeah.
couldn't buy the top of the line phone from Huawei. So now that they're back, what happens to Apple there? I mean, they'll still sell phones, but I mean, will they lose some market share?
I mean, just if a competitor, right, was largely removed from the marketplace and now they're back, and it seems like the initial reaction is positive. It seems like there's only one direction for Apple's Chinese market share to go, and it's not up.
Where are you seeing opportunities then? So are you looking in the same basket that I'm looking in that small cap value basket, or not value basket, but like the intersection of value, quality, growth that are
Yeah,
being sold for?
yeah. I think stuff like, I think a great example right now of, this is me speaking as an individual, not on behalf of Wook, but like something like a Virtu, where you're in a sector, financials, that's not really um, in vogue. You have, I think, a pretty solid business model, although you have some hair around it, kind of with a Wells notice hanging over your head. What I think is kind of just a nothing burger, to be honest, about what they've come after them for. Um, but it's a solid business. I actually saw, who was it? The French Hidden Champions Substack writer. I cannot think of his name right now, but he had interviewed a manager who'd been in the industry for like 4 decades, and it was interesting to see him call out Virtu as the most interesting idea that he's seeing right there. So it's like small cap stuff in hated sectors that are not sexy businesses. And I don't think people think of market making as a very sexy business. I also don't think it's a business. I mean, yeah, there are real risks outstanding for sure around like what is SEC in fact going to enact about changing the rules of the game, but just the valuation's really not demanding. I like that there's a lot of alignment with how it's owned. by insiders heavily and how they've deployed capital. So like, not to go off on a Virtu tangent, but that would be the type of stuff, the smaller mid cap stuff that's unsexy. I still am a big fan of Allison Transmission. Unfortunately, it's appreciated a lot, which I guess is some people like that. I mean, I've had to reduce my position because the forward returns I think have now gone down. The stock's up like 60 something, 70% in a year. But I also think in Monative, I know you're in the audience. Like I heard you and Paul have a great discussion on defense, and within that industrials, the broad industrial space, there's stuff that's again not sexy, but can you get a double-digit return without any demanding kind of multiple expansion? I think you really can, and this is that sort of stuff that's off the beaten path. I really don't like U.S. large caps broadly. I mean, there's some like again like I like CVS. I think CVS has some questions around the broader healthcare strategy they've undertaken and how much they spent on some of these health services businesses. But then when you kind of just look at how much cash the business generates and what they, it seems, famous last words, that the bulk of the acquisition activity is done and it's now about digesting it. And stuff like that doesn't look very demanding to me. And I don't know that. I know it's been in vogue for a long time to say, yeah, Amazon's going to disintermediate all of these local pharmacies, and I'm not so sure that happens. I mean, I don't follow Walgreens Boots as closely. I've seen that stock's way down. Maybe there's a good reason for it that I'm not aware of, but like, yeah, I would say stuff like that, and maybe sectors that haven't performed well, the valuations really aren't demanding. You have some. Maybe there's some hair that people won't touch it. Maybe it's the size issue. It's too small for some people to touch. Obviously, CVS doesn't fit that. But, energy had a good day today. I still think a lot of energy is pretty undemanding. Again, it's not sexy, especially when we're not talking about the green stuff. But I think I was happy to see. I've talked about PPF a while, and it made new all-time highs today, which is like, I like to see, and I also don't, because I would have rather they used more of their buyback program at lower prices. But yeah, I would say I would steer clear of communication services, IT, discretionary. But I also don't, to each their own, right? I wouldn't say no to any particular sector or say, right? It depends on what your world is, and I don't want to say anything is off limits for at least for me. But yeah, I also think some of these staples, like I don't need to preach to the choir to you, but like I look at British American Tobacco at this point, I'm just like utterly stunned at how undemanding the valuation is for you to get a really solid return in the coming years. I don't know if you follow Librarian Capital's notes. It was interesting. I saw he had reinitiated a position, and he, in his IRRs that he puts out, he was calling for a 30% IRR through 26 through BAT, and it was calling for an exit multiple of 10x. But again, as you and I both know, that the shift from the mix of revenue and profit provided by combustibles versus reduced risk products. I mean, I don't see why that's unrealistic if the trend continues, given where PM trades. So, yeah, I think there's a lot of interesting stuff out there. I know some people love to just say the market's super expensive and and throw up their hands, I guess, but that's really not it's really not a productive way to approach it. I think you can agree that on its face, it's on the richer end of history. And you just have to look for pockets of value. Look, do your due diligence, and of course, it doesn't matter how much due diligence you do. You can certainly be wrong. And we had our book club earlier this week on Fooled by Randomness, which Joe, I don't know if I'm not sure where Joe went to, but Joe's going to upload that, and there's only so much we can control, as we all know.
No, I couldn't agree with you more, right? There's the story of the 6-foot man who drowned in a river that was 5 foot deep on average. So we're all just trying to do the best that we can. But I would broadly agree with you on British American Tobacco and with Librarian. So I actually exit at around 10 times as well, and my forward IRRs are similar. But it's the question for me that I have in my portfolio. So, British American Tobacco is, let me pull it up. It's probably, about a quarter of my capital, but it's 37% of my portfolio's next 12 months earnings. So the question is, if it works, it's actually going to go up as a percentage of my portfolio because it's my second highest IRR or expected IRR. Altria being my lowest expected IRR. So the weight actually goes up by 2028. If I'm correct, big if there. So the question is, do I add to it? And that's something that I've been working through with the help of, friends. And I think I'm making the correct decision by adding to, something else that brings me, diversification.
Yeah, you've already got some pretty elevated exposure and idiosyncratic exposure to FDA.
Yeah, I've got 92% exposure, 92.5% exposure to the FDA. So I need to
I just want to go
diversify.
back and have Swedish Match back, man. I just hate Philip Morris for stealing it from
Oh
us.
my God, man. That was the perfect company, right? You could have sold every other, tobacco company, and you could have just only owned Swedish Match, and it would have been perfect.
How not to behave when you are kissed on the dick by a rainbow.
What a wonderful title. So I've been trying to learn more about the pet space because I think that there's a very high willingness to pay. Similar, to the dynamic of tobacco, but it's not because of addiction, but it's because, people care.
It's a form of addiction. It's emotional addiction.
Yeah, no, exactly. Right. And I think of my dog as an extension of my family. So there's a really interesting stat that I got, which was specialty and emergency vet care on a per pet basis is expected to grow at a 9% rate through 2042. So through the next 20 years, that's a pretty fabulous tailwind. That's almost like TransDigm. And if you could get a pure play that was purely these clinics, and currently they're private, they're owned by private equity, but I assume with, all these guys are rolling up these vet clinics with, like SOFR plus 700 or 500, credit facilities. I think that the U.S. is probably less likely to cut than Canada. And I think Bill's done, work on, why he thinks that the economy is strong. It would probably be reasonable to assume that some of these businesses would IPO, and, if they get a good valuation in this market, it would be actually rational for them to raise equity and take out their debt, and then you would actually have access to be able to, invest in these companies through the public markets. So that's an area I'm trying to get a lot smarter on.
I think I agree with your sentiment that there's some really good long-term tailwinds for pet, and I do not have one in my household yet, but I know it once it's in, right? Most people, assuming they have the financial wherewithal, which is probably the big question mark, is how does that perform in a recessionary environment? I haven't researched it enough to understand what, are people going to get rid of Fido? If they lose their job and they can't, really afford to get him Blue Buffalo anymore,
So my
is
buddy,
there as much stickiness?
worked at Rourke, and they used to own Pet Value, which is now public on the TSX, and they bought that business in the GFC. and it comped 5 to 6% during the GFC. And people think that, this is a business that's a risky business. Like today, I would not, if pet value is cheap enough, I would buy it just because, they've kind of hit saturation, or they're getting close to saturation, which is why, Rourke IPO'd them. But just that nuance, right? That they were able to grow comps at 5 to 6% through the GFC, is a testament to the willingness to pay in that category. I think aerospace, another one, TransDigm, if it got cheap, is a fabulous business, and RPMs I think comped 4% during the GFC. So I'm not sure that RPMs go backwards in a recession. So I don't know, just spitballing.
Yeah, no, I know Moniv's in the audience, and as I mentioned before, he and Paul had a good chat earlier this week. Maybe Joe, if you could maybe look for that, or Moniv, if you're able to maybe share it and we can pin it. But yeah, defense. I mean, I have on my screen one of our favorite writers, Mr. Mobison's ROIC kind of graphic he had a few months back, and defense and aerospace, to the point you just made, it's the range of outcomes, at least on ROIC over the last 30 years, is pretty narrow, and like the low end of the return band is higher than almost every other industry. So like even if you pick the 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 laggard of the bunch in that space, you're likely looking for pretty good returns, and right now the valuations aren't very demanding. So I mean, I had owned TransDigm, and I feel like an idiot because I sold it last year at one point, and of course it went straight up since I did that. But that's fantastic business, and it's like the risks are, I don't know. They have pretty nice little sticky moats and business models, a lot of them.
And the guys that they hire too. So I know that business really well, just because my family, has four FAA certified product lines, and the way the contracts are structured, people don't understand that they're not gouging. First, you take a bath on getting a product through FAA certification, heat testing, electrical testing, vibration testing, etc. All that costs money, and all of those are lab days and specialty lab days, where you have to rent out a specialty lab. Then once you get the product approved, the OEM typically has price reductions built in. They capture all the savings from TQM, all the savings from procurement, all the savings on volumetric production, right? So if there's a little bit of inflation in your cost structure, like in the BOM, you're basically screwed, right? So you're a slave for 12 years, let's call it. Basically in the last 2 years, you'll get CPI pricing, but you have to, earn your return in years 12 through 60, right? So Nick Howley has been very smart about, how they've targeted specifically the aftermarket, in my opinion. And I just think it's a fabulous, fabulous business. But again, this is...
What kind of IRR do you see from here? It looks like next 12-month EV/EBIT is 20 times right now.
I have a
close to 30.
disease. I have a disease. I could not buy it.
Yeah. We share that disease.
Yeah. But the one thing I will tell you, though, is just the look-throughs on our numbers is that demand is still strong. Demand was not as strong from 2015 until Russia, right? Because you had, basically Obama had pulled out of Afghanistan. I'm talking about the defense side specifically, not commercial. Commercial has been strong, but throughout. But defense specifically, we have noticed a noticeable uptick since Russia. So I forget who it was. I think it was future former JD had tweeted, buy the Lockheed Martin puts 290 for 2025. I would not do that. I think you're going to lose money if you do that.
He's not going to be able to get his 206K BTI if he's throwing out premium on LMT puts. Come
Yeah.
on. Valentine, you had come up, but did you want to get a word in? Did you want to chime in? I had added you. I didn't mean to have us keep speaking. Okay, well, feel free to chime in when you want to. Anyone in the audience, if you want to request to speak, feel free. My intention is to run this till 6 o'clock Eastern, so it's 5:12 now. We've been going since about 4, and we can talk about whatever people want to talk about. Again, for anyone just joining, if you want to follow, I'm kind of on my screen, kind of pulling up companies and Koifin on some of the views that I like to use, and I have that screen share in the Stages channel in our Discord. Obviously, audio only here on Spaces. But hey there, Monative. Happy Friday. This is, I know, your your ballpark. This stuff.
Happy Friday. How are you guys? So, setting aside the industrials defense for a second, going back to what you were talking about tech, I think this is a problem I've been, seeing across the board on most people that are negative about the direction of the market. There's a difference between, challenges to the business and the business upending itself in a very short time. Like you talked about the Apple example in Chinese market. I don't think the Chinese market's going to blow up for Apple instantly unless it's a quick and instant political decision, which by itself has two sides, right? There's going to be massive problems for China if they do something like that. So it's not that these things happen fast, so there is still a long period of time.
I'll just note for a second here. We did host the previous book club in the Discord.
Can you not hear
so if you haven't
Monative,
joined,
Joe?
oh no, I can't. I was gonna just
Okay.
throw another one.
He was
The book
speaking.
club. Go ahead, Monative. I'm gonna rejoin. I can't hear you, buddy. All right, let me rejoin.
Sorry about that, Joe. I don't know what happened there, but no worries at all.
Just Elon's gremlins doing their thing.
Yeah, whatever, man. That guy's nuts now. What was I saying? Yeah, so I think so it's a time perspective thing, right? What what is really the period of time where where you're investing for? If it's the next couple of years,
right? Are you taking a long-term investment, or are you just looking at a
well,
very
even
short-term
what is long
speculation?
term, right? So if it's the next few years, I can I can easily find a dozen investments in tech that should do high teens comfortably. If it is 5-6 years, I don't know. That's too long in tech to know anything, right? If it's the next few quarters, there are dozens, right? So it's there's a lot of places to make money, and it is not always the same place that people are used to, and that's because here in FinTwit, it's a function of traders who started their entire journey in investing 2 years ago, and they just talk what they know. So that's really not, that's neither here nor there, right? So it's purely, if it's purely a matter of you know, let's say a few quarters or longer investment, or even, long swings of, 1 quarter plus. There's plenty in almost every sector that you can find that still, has a reasonable risk reward associated with it. So, it's up to people. I think broad brush, descriptions of a sector as being, topped out, or you know um, played out completely, and no big opportunity left is dangerous, right? I mean, even take aerospace and defense for that matter. Commercial is really at the mercy of of Boeing. If Boeing continues to find new ways to screw up, it is going to make revenues for almost everybody in commercial a little bit more lumpier than it should be, a little bit more unstable than it should be. As long as I guess transports are doing well, the replacement market, your Transtimes and others that, or even the MRO market, people who supply into the MRO market should do just fine. But anybody in the that supplies into a new plane, they are at the mercy of Boeing and or Airbus, and one of these guys screw up, or for that matter, the engine maker screws up. You've got a plane sitting there, and you can't recognize revenue for, I don't know, a month to 5 years, like it's been in the case of Boeing for some of the planes. So, I mean, in every sector, I think you have to go far deeper than, people looking at charts and saying, yeah, this is going to work, or numbers saying this is going to work. I think that's the difference between, 2 years ago and what you have to do now is you have to dig much deeper into the business and really see what is left, what are the drivers, and where is the real competitive advantage, and is it sustainable into a weakening economy. And if you do that, I guarantee you, almost in every sector there are companies that you can have better than normal risk reward and get your, let's say low teens return. It's not that difficult, but it's not in the charts anymore. It's got to be some real work behind it.
I wonder if we queried the audience, how many people would sign up for 15% annual return going forward
Guaranteed?
10, 20, whatever years. Yeah.
Oh, I'd take that in a heartbeat.
I know you would.
Yeah, but yeah, you're not the audience in stock. It's that this is the problem, right? People are used to
You're saying
that return every week,
guaranteed?
or at least what they claim.
You're saying guaranteed. Like, when Charles
I'm
Barkley hits
saying
the
that
button, he
because
goes,
I'm saying that
guaranteed.
because I, I'm saying that because I hadn't seen a really more recent survey, but the last one I had seen of it was that, kind of investor forward return expectations were kind of in the high teens. I think it was 17+%, and it was kind of on par with where we were in .com. So I think return expectations are higher than that for many people on this platform, which I think is unrealistic. And I agree with you. I would take the guaranteed return, but I don't think that market participants broadly actually feel that way right now.
I would take that return, that guaranteed return, and I'd lever it. And then I'd beat them, even after their higher expectations. So have you polled FinTwit and asked them? Or where's this number coming from, the high teens expectation?
I am trying to find the report that I'm referring to and who was surveyed. Let me see what I can find.
Yeah, going back to what we were talking about in industrials, right? Just take industrials as a group for a second. You know, there's so much money pouring into capacity building, and it's far from done. So, if this continues even for the next 2-3 years, let's say, because the investments are already committed and kicked off, and it's it's more than shovel ready, right? The shovels are already in the ground and working. You've got a lot of these companies that supply into that should continue to do well. Industrial controls, industrial automation, machinery, industrial construction and engineering, and all the related stuff. And if you extend that outside of industrials, you have the control system software side of it, the IoT side of it, you have industrial cybersecurity. I mean, the point I'm trying to make is you can pick where the capital is going, and if you follow that along, you can branch out into almost every sector of S&P and find plays that are not played out. You guys there, or am I talking to myself?
Yeah, no, I agree with that sentiment. Sorry, I was I was skimming the document, but I was trying to relay those return expectations. So the gap. So this is a Natixis survey, and it's from June of this year is when they published this. So survey findings suggest that after more than a decade of outsized returns, U.S. investors have been conditioned to expect high returns despite the harrowing experience of 22. Long-term return expectations remain high, 123% higher than what U.S. financial advisors think is realistic. So yeah, that's kind of the. I don't think this was the exact survey in question, but I've seen a few of these where it seems that broadly investor return expectations are just still very high and not commensurate with what reality is likely to be.
You know, what's really funny is classifying 2022 as harrowing by any stretch. It was a few months of a pullback. That's it. We're so conditioned to 2020 and 2021. Well, okay, 2021 return in that case. I think that's more a function of the loud mouths on FinTwit, the big ticket name, the big follow names here on FinTwit, saying those things because that's all they know and because they just started now, more than almost anything else. It's really not based on data at all. That people think. I mean, come on, how can you call that harrowing by any stretch? Tell me.
Yeah. The data point from the 23 report is expectations for real returns of 13.6%. So it had come down a little bit from where it was previously that I was referring to, but it's still
That's
high.
elevated, right? If inflation is 4% a year, that's a 17% nominal return, right? If it's
Very high expectations.
if it's
Yep.
2%, then that's a 15% nominal return, right?
But can you blame them? That's what the market's returned in the last 15 years, or not necessarily 15, but the average annual total return for S&P from 2012 to 21 was 16 and a half. So recency bias is driving a lot of investor, I think, behavior and perception.
Yeah.
I don't know, Rod. I mean, if you can get a 10% growth in share price compounded every year, get a 2 to 3% yield, and get another 2-3% from from selling covered calls, I would have thought that would be pretty damn awesome. Expectations are just crazy, and people don't look at the rest of the side of earning money from a stock. They just purely look at it from the stock price appreciation point of view alone, right? And then if you really want a high teens appreciation purely from stock price, then your risk goes up substantially, right?
So the number I read off was across this survey pool. Let me be more specific to the U.S. In the U.S., expectations of 15.6% above inflation is what the survey results show. So more than 18% is what the U.S.-based survey respondents are expecting, which is obviously far and away above some of the best investors in the world long-term performance.
That is absolutely insane.
So sin stock, I would say many of those respondents wouldn't take that 15% guaranteed offer.
Over what period, though? So over what period am I getting a guaranteed 15%?
I don't know. Andrew, please go ahead.
Oh, hey, Rod. I always love your spaces. It's great discussion. I just caught the beginning or the tail end. What you were talking about Ryder, and I like them. I love how they sort of they're very conservative on their estimates, and especially the dividend policy. They keep hiking that up. I know you know the next few quarters. You think the next few quarters are going to be challenging for them. I tend to agree. I was just going to comment on a couple things that were said before. I think there was a Dollar General and British Tobacco. Low end consumers. Why are these things not performing or performing so poorly? And I think Dollar General was just I think it was just because their earnings had exploded through the pandemic. I think they went from like earning $5 to doubling to $10, and now it's pulled back a little bit, maybe 750. So yeah, you're getting a lot of moves. I think a lot of the earnings were pulled forward, and they're correcting a bit, and so are margins in areas. So I think that's part of it. But you do have a little bit of a dichotomy. The companies like Walmart, Lilly, or Costco's, they're all performing super well still. So they're all firing on all cylinders. So it's an interesting place where we're here. But I do agree with Monativ's perspective. I feel like everything's not going to be in the charts. You got to dig a little deeper now and do a little get yourself a little more dirty before you find the golden nuggets here.
Bill, I know you came up before you chime in. Yeah, on Ryder, Andrew. I mean, look, we're all shaped by our experiences, and my experience, having worked there from 17 to the end of 21, was that the time to buy it will be when kind of the equipment market in particular has really troughed out. And this cycle has really thrown a wrench in kind of the normal relationship between the freight and equipment markets. So used truck prices are still extraordinarily high. Used tractor have normalized more so than truck. And I'm with you though. Long-term secular trends of nearshoring are great for their business. They have a big operation in Mexico, and I look forward to returning to the Ryder investor pool. I think John Diaz, who I worked very closely with when he was the head of fleet management solutions, and he's now the CFO. I think he's a really sharp guy who is going to do great things and continue to do good things with capital allocation since he became the CFO. The dividend's always going to be a primary means of cash return for that company. I don't think that'll change, but it was nice to see them, start to lean on the discretionary buyback, especially as they had delevered so much. So yeah, I think they have good leadership in place and they have a good strategy. And it's just it's a boring transport and logistics business. What I'm really interested to see with Ryder is what they decide to do, because every single year for the annual board strategic planning process, we do some of the parts internally, and every single year, it spit out a price above $100 per share. And the big thing has always been that supply chain solutions, their warehousing, distribution management business doesn't get fairly valued within the Ryder world, and that the kind of cross-selling capabilities of the fleet management's sales team to cross-sell to to different buyer of the services, that there's maybe not as much of a need to keep the businesses all under the same umbrella. And I tend to think if they don't get what they think is the right valuation by Mr. Market as we come out of this freight recession, that they would pursue strategic alternatives for the supply chain business in some capacity. But again, I haven't worked there in almost 2 years now. I have no insider information. This is just my perception, having been in the boardroom for a lot of meetings.
Right. I appreciate that input, and I tend to love when some of the boring well-run companies outperform, the sexy high flyers. And I was even looking at Kroger for a second today, with the deal, and their forward earnings are like 10%, and the free cash flow yield is like 7.7. So it's not terribly expensive here. It's interesting.
I pinned that Natixis survey, by the way, that we were speaking about. But Bill, saw you come up. Happy Friday, sir. Did you want to chime in?
Yeah, hey guys. Yeah, it's kind of an interesting market. I think there are obviously some high flyers, but I do think there's also some areas that have just been left for dead. And if you're willing to kind of do the work, there are sectors I think that are still pretty cheap. But you have to sort of really, I think someone mentioned it earlier, I think it was Monative, you really have to do the deep digging to kind of understand which ones are worth owning and which ones are not. So one of the areas I'm picking through right now is the regional bank sector. It's been left for dead since March. It's had a little bit of a pickup, but really has not really recovered ever since SVB. And I do think it's basically, there's ETFs that just own bank stocks. That's how most people get their bank exposure. So everything is just being thrown out sort of indiscriminately, and probably for good reason, I'd say in 90% of the cases. But if you're willing to dig, there are some real crown jewels that are just really cheap right now, and worth looking at. But you kind of really have to know what you're doing. You have to sort of look at the balance sheets in particular, and just understand what the loan book is composed of, what the securities book is composed of, what kind of deposits the banks have, how much of it is sort of insured versus uninsured, that kind of stuff. But if you're willing to do that, there are, like I said, some real jewels there. And then, another sector now that's getting kind of trashed a little bit again is the automotive sector. Again, probably because of the worries about the strike, with GM and Stellantis and Ford. But some of the auto suppliers are feeling it again, the brunt of some of sort of that worry, and some of them are starting to get cheap again, which to me is, you can get high quality companies at like 5 PEs. It's worth doing. But I don't know.
I know GTX is one you brought up in the past. It looks like I see it at 7 times forward right now.
Yeah, it's cheaper than that actually. I think it's closer
Okay.
to five times forward. And they've bought back a ton of stock since they did their big recapitalization. I think they've reduced on like 25% of their stock in like 3 months. So it's been sort of a simplification and also a reduction of the common equity. And again, I mean, it is got a lot of exposure to internal combustion engine automobile production, but uh, I think it's still a good enough business that you're getting a very high quality business with a fair amount of protection. I think in terms of it's kind of like a duopoly globally.
Right. Them and
And so
BorgWarner broadly.
yeah, and I whether you believe them or not, I think GTX is getting more wins on the production front than BorgWarner is. I think BorgWarner is not really investing behind this business anymore. They're sort of trying to expand to other sort of more growing segments, whereas I think GTX is completely focused on carburetors, turbochargers, sorry, and they're just going to, I think they're just going to continue to win. So the question is, do you believe that this is a buggy whip company that is going to disappear, because everybody's going to be driving EVs? I mean, there's some, I think that's what the overhang on the stock is.
Totally. A lot of these automotive suppliers, it's just what you said, that there's uncertainty around the durability of the internal combustion, and and it's unknown what they're going to take in the EV world. I mean, we were internally doing work on some of the automakers, and it's just the range of outcomes for the auto OEMs themselves seems so wide. I agree that I think there's more. Maybe the fish are going to be more attractive if you look in the suppliers even though like stuff on its face looks really cheap, like Stellantis looks really cheap on its face, three times forward PE per the sell side, but who knows what the resolution of this labor action is going to be and how much higher their cost structure is going to be. And obviously Stellantis also has a lot of inventory out there, I think, right now in Jeep, but it's shorter term. Andrew, you wanted to chime in?
Oh yeah, I was just gonna say for GTX Bill, do you know? I know there are a couple of hedge funds with some pretty big positions. I believe they were from the preferred deals. I think like Howard Marks or Seth Klarman have pretty big positions. I don't know if they're going to be selling those positions off because of the profits they made off the preferreds. And if that may have weighed in on some of the near term price weakness. I know it traded up to like 8 and then it pulled back to around 7.5.
Yeah, no, I think, I think that it was an event of liquidity when they did kind of the conversion of the preferred. So I think they took a little bit of money off the table, but they're still, I think this is still a largely closely held stock by about 3 or 4 hedge funds that were part of the recapitalization coming out of Chapter 11. So I think they still own something like 60% of the total common equity. So they can't all get out. I think they wanted to kind of maybe take a little bit off the table since they had been in it for 3 years, but they're still there, and I think they still are committed to the business. So kind of we'll see what happens. I do think part of the problem in the short term right now with the stock going down is I do think there's worries about strikes in the auto industry, and I think that's what's affecting them and affecting a lot of suppliers right now. I mean, volume's been down because of the pandemic, right? Production volumes. So the volumes have picked up this year, and sales volumes have even picked up. But just when things sort of were turning for the positive, now you have sort of all this uncertainty about whether there's going to be a strike next week or 2 weeks from now.
Hey, Valentine, did you want to chime in?
Good day, everyone. Sorry, this might be a little bit of digression. My name is Valentine. I'm from Nigeria. I was just checking different spaces to see, because I am trying to build a startup, and I was looking for angels that I would pitch. So I think I might have misunderstood. I've learned a lot, so I think I might have misunderstood from the title of the space. So if I would like the opportunity to pitch somebody, if anybody's interested, they can reach out to me privately. If it's fine with the house, I can do it here. I can still pitch the house as a whole, see who will be interested in what I'm doing. But other than
No,
that,
thank you though. But if anyone's interested, please reach out to Mr. Valentine. But yeah, please let's not have this devolve into that. Right now we've got 20 minutes left till we're gonna wrap. So appreciate it. Yeah, I mean, Bill, to the point you just raised though, that sort of environment where a short-term event that's going to cause disruption. You may get some stuff that gets sold off too much. It's obviously disproportionate to the impact on the terminal value of the business. That's a great place to look for bargains. So let's see how this labor issue resolves itself in the coming week or weeks.
Yeah, I mean, there's a lot of interesting areas. Like I find sort of this battle between Disney and Charter fascinating. And it's another area where the industry is changing dramatically, and it's sort of come to a head now, right? And again, I think there are some really cheap stocks here. Not so much on the media companies, which I think they've broken their business model and it can't be fixed. Is I think the realization everybody's coming towards, like the Warners and the Disneys. I think they had a sort of a good run, but they're kind of like the newspapers now. I think they have content, obviously, and content libraries, but the real cash flows were in this sort of linear TV business, and that is now broken and isn't coming back. And I think the flip side of it is you've got the cable companies that are basically saying, and I think it was Cable One sort of highlighted this almost 10 years ago, saying, we don't really make any money on video, right? Like the linear cable, traditional cable TV video product, right? We just don't make any money on it, right? Broadband is sort of the future and the cash cow, because there's literally no content costs that you have to pay for, right? Like as a cable company, right? You're using the same infrastructure. You're delivering sort of the bits of information that people need for the internet, but it doesn't cost you anything to deliver it, as opposed to, let's say, delivering ESPN to a cable TV viewer. And you're seeing sort of Charter now finally sort of say the quiet part out loud, which is, we don't really care. We really don't care if we don't broadcast ESPN anymore through the linear TV, because we don't make any money anyway. So it's just fascinating kind of to watch this now finally erupt. And I think it's really bad news for a lot of like the Paramounts and the Warner Brothers and the Disneys, who really still rely on that linear TV for a disproportionate amount of their cash flow, while they build out a streaming business that just loses gobs of money, right, as it grows. So it is interesting, but for me, it puts again the focus back on these cable companies have been left for dead, and I think, again, they look cheap. Now they're levered. They are kind of like the banks. They are levered quite high, but some of them have just really been absolutely pummeled for the last year and a half and look pretty cheap to me. But I don't know. It'll be interesting. By the way, it does look like Disney blinked. I don't know if people noticed this, but they took the Monday Night Football game from ESPN, and they're going to offer it on ABC, the traditional channel, right? That's a blink.
Yeah, Bill, I kind of agree with your sentiment that the whole space is just going to be tough to see how there's just so much ongoing spend needs, and
So
I don't
I
know.
was looking into this on the Charter Disney thing, and I guess the Charter sort of made a counterproposal that they want what I think amounts to Disney Plus included in the subscription. So customers don't have to pay for it twice, because you've got all this direct to consumer content now that Disney's trying to produce, and ultimately Charter's fine with the higher market rate, but they're just going to keep bleeding customers if their video subscribers have to basically pay for a separate service to see the show that they really want to see, and they're just going to end up canceling video. I mean, the fees for the carriage rights has just gotten outrageous. ESPN used to cost, oh God, 60 cents a subscriber, like 25 years ago, thereabout. It was $5 10 years ago, and now it's up to it's just under 10 or just over $10 a sub. And
I think it's high. I think it's higher than that.
Oh, it's probably higher than that, yeah.
And the stats are every subscriber pays for it, right?
Yes.
When really only 20% actually watch it.
Yeah, that's totally correct.
I think that's what Charter's argument is, right? Like why, they're sort of arguing, they're arguing for their own self-interest, but they're also arguing on behalf of their consumers, right? Saying,
well, yeah,
we really want to offer, we want to offer skinny bundles that don't include ESPN, or include it, but don't force us, because that's what their complaint is, right? Disney locks up all of the cable channels that Disney offers and says you have to take them all, and you have to pay the price for each one,
and then they offer a whole bunch of this direct to consumer content, like a lot of the Star Wars
and
stuff.
Charter says, look, all we're doing, and then on top of that, Disney can hike fees, or hike the carriage fees, and then hide behind the cable companies when the cable companies have to face their consumers and raise prices on the cable TV it's been kind of a sweet deal, right, for the the content providers, because they don't take any of the heat from the consumers for the rising prices. That's why everybody hates the cable companies historically, right? Because it's the cable companies that jack up your monthly bill. But really, they've reached a point now where they say, you know what, we're not going to do that anymore. Disney,
Yeah.
if you want to raise prices to your consumers directly.
I mean, it's there's sort of this break-even point for them, I think, a Charter, and they're just losing too many video subscribers. It just doesn't make sense anymore for them, right? So
Well, even more than that, right? Like, I've seen presentations from Cable One that say the video product ties up a big chunk of the throughput through their pipes, right, through the through the actual cable plant. And by Cable One's actually come out and said this. Right now, they're a smaller player; they don't have the leverage of a Charter, but they've said that they're probably a couple of years away from completely eliminating on offering a video product to their consumers. They're going to just package streaming, MVP providers like YouTube or Fubo or whoever, and say,
yeah,
here's your
that's what
linear
Charter's
TV.
telling. Well, that's what Charter is telling their customers to do. Just buy Fubo.
Right. And well, what happens is this will free up an enormous amount of capacity, right? So suddenly now, the cable companies, if they no longer have to provide this video product, can now reach like 10 gigabyte up and down on broadband, right? So I think
potentially. I mean, I think they've gone to a lot of IPTV kind of a style of broadcast, but there is that signal to the node that then goes down the pipe. So I think it's like it's not your last mile, but it would be your fiber data to basically your local area node, that then goes to copper for the last mile. That would probably, yeah. I mean, if you're right there, that would probably free up quite a bit of the bandwidth.
Are you talking about DOCSIS 4?
Oh God, what's DOCSIS 4 now? The last time I remember that, yeah, which is, I know that they were on 3 the last time that I was really taking a look at this.
The current one is 3.1, but I think right now 3.1 is limited by the number of upstream channels. So upload speeds are limited at like around 35. But with DOCSIS 4.0, it would be in the gigabit range, or like many hundreds.
Well, I mean, I know that my parents actually just got broadband. They live out in the middle of nowhere, and it was just a pure fiber installation. I don't know how DOCSIS affects that, or if I always thought DOCSIS was always the copper and not necessarily the fiber. But I mean, it's crazy that you have this business here, that started in really the 90s in terms of like, they were going to provide broadband on the copper pipes because, coax was bigger, had a bigger, they had basically had a bigger pipe than the phone companies. They were able to offer this bonus revenue. And now it's kind of become their primary source. And, it's sort of interesting in that regard. That's sort of a sidebar, but.
So almost all of the providers have gone fiber till a point, and then the last mile is the only thing that's slowly changing, right? So DOCSIS is just using coax for the last bit of it from their street corner box somewhere to that. But if you, in the same stream of thought, right, look at the performance of Cisco and Arista and edge providers like that. Yeah, there is plenty of demand for network edge products to upgrade the network. So which means the buyers on the other side are seeing demand, right? Like you guys are talking about, the Charters and the other companies of the world are investing in these, which shows up in the results of your network edge provider. So yeah, I mean, you can confirm that data in multiple ways, and I'm just throwing that one out. I'm not suggesting Cisco, but Cisco and Arista's performance clearly is a function of that.
Yeah, I just think it's reached the point now where the Disneys and the Warners and the Paramounts had the leverage, I think what you're seeing now is maybe that leverage is gone. And this is kind of an existential problem for Disney and the others, because
and they created this problem because they started, in an ironic way, I think their direct-to-consumer offerings actually reduce their leverage in linear. Because if you've got all your subscribers that are leaving anyway, who are canceling for the linear, for the direct-to-consumer product that you're now offering, then why the hell does Charter or Comcast or whoever else need to even worry about the video product? It doesn't make any sense because their consumers don't even want it, and it's not really even I think my when my mom signed up, she wasn't even offered a video product. I mean, they actually did, they still want to do the phone a bit, but she actually had to ask for the video product. So they just didn't care, and I don't think they do care. It's not a margin business anymore, and it's a headache. In the grand scheme of things. So,
but I think the problem is for Disney, let's say, is I don't know that streaming is ever going to be as successful a product as this linear TV product was for them.
Oh God, no! Of course not. It's not actually.
That's why I say, I think they've broken it. I think they've broken it, and I don't think they can put it back together again.
Well, look at it this way: does Charter offer Charterflix? They're in the video delivery business, but they don't offer anything of their own content in any meaningful way. Why? Because nobody makes money on it. The money was always in these massive, linear TV deals and sports in general. Huge money in sports, like billions upon billions of dollars every year. And that's going away. And, and now they want to, that they've all sort of, try to chase Netflix here, and they can't beat Netflix because Netflix is too damn big. I don't know.
But think about it though. They had a business model where they got paid by subscribers who didn't watch their product.
Oh yeah,
right?
Totally.
And then on top of that, every time the price was raised, they didn't have to face that. Now Disney Plus, if it has to raise prices because it is direct to the consumer, they're going to feel the brunt of the blowback if they raise prices, right?
Yeah,
Consumers they'll just shut the system. They'll just say,
it's not just that, but it's also like, when you were in the cable TV world and you had that huge linear TV package, when you were done watching something on Comedy Central, that show went away. You didn't cancel Comedy Central. But now, when you're done watching all the Ahsoka episodes, you might cancel Disney Plus. It's a horrible business model for retention. It's just, yeah, I mean, that's why nobody makes money on it. I mean, you could be Netflix, which made it work just by offering just an endless breadth of content, that there was just always something new to discover. But when you're a Disney or a Warner Brothers and you've only really got your own IP properties to offer on your services, I mean, it just doesn't make sense. It's hard to retain customers, and that I don't know. It's not good for them. It's not good for Disney. And Disney's like, weren't they also like trying to sell a stake in ESPN too? So they're trying to get, they're basically going to Charter here. And Charter knows the game. That's the thing. Like, Charter is realizing, like, wait, you're just coming to us because you want to get a massive pile of cash for your own purposes. This doesn't really benefit us, right? So Charter's told them to go take a hike. Or at the very least, given them a reasonable counterproposal, which is, like, you've got to include Disney Plus in the package. And, there you go. Because it's
or break up your bundle so we can offer smaller packages.
Exactly.
Don't lock up your entire, Disney Junior, Disney XD, ESPN, ESPN2, all the package that you offer. Don't lock it all at once, all together, and force us to buy the whole thing and put it on our basic programming unit.
And it's not only that; it's also the fact that you've got anybody who's under the age of 50 who just hates commercials. I hate commercials. I will pay you to not show me commercials. Okay.
Well, all the streamers are going that way too now.
Exactly. It's the problem with the commercials is just the repetitive nature of it. I mean, one, you had, it used to be commercials was really just for broadcast, right? And then you'd have linear TV packages that, the whole purpose is you were paying a premium for them because they had less commercials at the very least. And then now all of a sudden, they've got more of that commercial advertising, and it's just like, oh god. There's only so many breaks to get up to go to the kitchen and on the show you're watching that you can have in an hour before
So
you're
the
just
pause button's there
DVRing the
for.
damn thing.
Joe, you want to chime in?
Yeah, sure. I just hear a lot of qualitative, subjective arguments about how it's the end of content, and I don't know. I just disagree. I mean, I think content is still king, and to Chappie's argument about streaming is a horrible business model, I don't know. I think otherwise. I mean, I've had an HBO subscription because I wanted to watch the new Game of Thrones, and I never got rid of it. Actually, found a few other things that I liked on there as well, and Paramount Plus with Showtime. I mean, I got way more streaming than I ought to, but they're very sticky. And especially families with small children, you're not getting rid of that Disney thing. That's your babysitter right there. With regard to Spectrum dealing a death blow to Disney, I think everyone's cutting the cord. I think the death blow is to Spectrum. I've got this neighborhood board, which is usually old little ladies with white tennis shoes yelling at the clouds. But people are up in arms with Spectrum for cutting ESPN and Disney, and all this other stuff. They are absolutely furious, and they're blowing up Spectrum and demanding refunds. And Spectrum is low key handing out like $15, $20 credits and promising that they're gonna square this thing away within the next week or two. So don't think that this is just a one-sided thing. The answer, I don't know. Nobody knows. I don't know. I just, I've tweeted a few times that I'm nibbling on Disney here, and Disney's not just a streaming thing. It's not just, it's the theme parks, it's the network, it's the movies, the content, it's the streaming. I mean, it's a pretty big conglomerate there, so you can't just boil it down to a battle with Spectrum. If anything, I think it's a buying opportunity. But I mean, I think you guys are a little bit off target here if you think that content doesn't matter anymore. I think in the long run, content is going to be all that matters. I mean, and with regard to your comment about sports, that was shocking to me. I'm sorry. But the sports contracts, we're talking multi-billions. We're into, we're well into 10 figures now on some of these sports contracts, NCAA football, baseball even, which is kind of an old man sport at this stage of the game. But, the thing about sports is it's the only way you can compel people to watch your commercial. Because they want to see the event live. There's not a lot of joy and suspense unless you're a true fan and watching a sports game that happened yesterday or a month ago or a week ago. So I without going on much further here, I would just say content is king. It will remain king. There's a shakeup going on. We'll see how it settles. I don't pretend to know the answer, but I do believe that as we go forward over the next year, 2, 3, 5, 10 years, you are going to see the content providers demand a premium, and I think they'll get it. That's all.
Good discussion, everyone.
Well, yeah.
Lily, before you chime in, I was going to wrap the call at 6. I'll let us run another 15 minutes so we can keep kind of having this discussion. But Chapman, before you respond to Joe, Lily, do you want to chime in?
Yeah, I just wanted to add like 3 quick things. So first of all, when everybody talks about Disney, we kind of forget about Hulu, right? And there's they have a version that some people switch to from cable, right? Which has all the locals and you can add things onto it. Also, some of the content and some of the things with Disney including the parks and some of the other things also happening with Netflix, right? That's a form of soft power, not only for the US, but for some of the other countries. And that's a consideration just, where we are geopolitically that I think a lot of people don't discuss. The other thing is there was a piece in the Wall Street Journal earlier this week talking about just broadband, etc., which I actually am not super familiar with Charter, but I thought I heard you guys talking a little bit about that component when I popped in. And I guess my question was reading that, right, is how much of that can also go from a lot of the traditional kind of providers over to Starlink, especially looking at the prices the government is paying. Like they're paying a lot of money for some of these access points, just a lot. So I just wanted to add those and hopefully hear you guys talk about them a little bit.
Well,
Okay. I can say something about Starlink real quick. The biggest problem with Starlink is bandwidth.
yeah, it just doesn't
Yeah,
have, and latency.
but 300,000 or 53,000 for an access point, that's what the government's paying for some of this.
Well,
Or
yeah,
some of
because
the
the government.
tribal.
Well, yeah, because for if you're out in like the middle of nowhere, and yeah, that's just what it's going to be. That's the way that you're going to have to get broadband. But for like even my parents now have fiber and they live in the middle of nowhere. I mean,
Well,
it's
but and are the US because I know Orange, right? They were upgrading some of theirs to be hybrid, right? To also have Wi-Fi as part of it. When you're talking about latency and more data and all this other stuff. So I don't know if any of the US ones are adding any of that and doing hybrid, but they also have different coverage, right, in those places. Not the same kind of issues we're seeing in the US.
Yeah, I mean, basically, it's just the economics of density, right? The less dense an area is, the more expensive it is to bring, broadband to that location, right? And then the other, so fiber, and was and is a competitor to traditional cable, but the problem is the installation costs are going up, and once you've hit all the top MSAs around the country, now your economics just don't pay back, right? So that's why the government has to subsidize a lot of the rural areas. And then the second area that you're hearing about as a competition to cable is sort of the wireless providers, but again, they're very limited. Capacity is usage is growing so fast that even the wireless guys like T-Mobile are saying, like, we're reaching a point where we're not going to offer it much more because we're selling our spare cellular capacity. But the problem is they make 50 times the revenue on the phone side of wireless than they do home broadband. So the minute there's any congestion, they're going to just throttle the home broadband, and that's been the experience.
Well, the other thing just that I thought of real quick as you were talking, Bill, is also just thinking about what the government does with subsidies. I remember I was at something talking to a state senator, right, about where they had just expanded coverage and what they were paying for, et cetera, and what they were looking at developing out in other parts of the state. He that we were talking about, right? And he said even though it would have made, the other thing is, right, is even though it would have made more sense for the future, right, for them to upgrade to a certain part, the reality of it was that they weren't upgrading, right, or putting in systems that would allow them to upgrade easily as we go forward too. So I guess it gets more complicated though when you're talking about the federally or the state subsidized infrastructure, digital infrastructure.
Sick, I know you work in the industry. I saw your hand up and I saw you put it down. Did you want to chime in on this discussion?
Yeah. I can't say much about the Starlink thing, or the Charter thing exactly. That's kind of new to me since for anyone that knows, I actually did used to work over at the Mouse for a little bit. But to support what Joe said, yeah, Disney's gonna be fine. Like, they have a plethora of different IPs and titles. Like, they literally bought everything from Fox, Fox Searchlight, crap, Oh my god, hold on, let me just go back to this.
21st century.
Lucasfilm.
Marvel, Lucas,
Marvel.
Yeah,
21st, yeah,
21st
everything from
century.
21st
Star
century.
Wars, Marvel. Yeah.
Yeah, Lucas, yeah, they own a crap ton of IPs. I used to work in operations, so they have over about like 1,400 different title movies throughout the last 100 years that they could like pull out from. Um, that's a big one that like Netflix literally had to take 10 to 15 years just to build. You know, they were churning out IPs, but those IPs wouldn't last for more than like 2 or 3 seasons. But now we're talking about classic IPs like Aliens and Star Wars. And I mean, don't get me wrong, some of them are probably like overused right now, and there's probably like massive fatigue with like Star Wars and Marvel right now, but they got a lot of different things that they could use right now. So like if you are looking at the movie scene right now, they're already pulling out what was it, the Agatha Christie's Detective Poirot series, you know, from uh with the train on the the Orient Express, and then like Murder on the Nile, and now the soon to be a Haunting in Venice that's coming out later this month. So if they wanted to pivot, they could. Then there's point two. Hulu is being rolled into Disney Plus here in the United States. I have no idea. I can't see for sure what exactly they're doing on the business side because uh,
They're going to have to pony up, though.
well, it depends. I mean, like the other people that do own Hulu is NBC Universal, and they only own like 30% of it. And
Yeah,
depending
but
on
they
like
have a
how
put. They just were on. They just said they have a put option, and they're going to exercise it.
well, I can't. Well, let's see what happens with whatever happens. So like I can't say anything because I'm not 100% sure
Okay,
what
but
the the legal or the business deals might be on that side. That's handled by I guess like whatever the executives think of. And then on top of that, in terms of the money, a lot of these streaming services are raising prices. Like I think like this week Paramount said that they're going to raise prices for their own streaming service, and it's going to
And it's
continue
not
on
just
through.
the streaming services, all of the game services have done so. PlayStation's about to put a PlayStation Plus price increase through. Xbox just put theirs through. So it's all of these a la carte, not a la carte, these subscriptions are rising prices. So the consumer, presumably going back to Joe's point, is going to pick what they get the most value from. And I guess IP on it should drive that.
Yeah, and then on top of that, I just want to point out a couple things. I'm not sure if anybody here recognizes that Netflix has their own gaming.
I was just going to talk about Netflix gaming, actually.
Yeah, like I didn't even
Yeah.
know until earlier. I think I swung by there for like a meeting in November,
They have
December, and then I didn't know until somebody at Netflix told me, "Oh, if you have the mobile Netflix app, you could play games on." I'm like, "Wait, what?"
they
So
have a deal with Ubisoft too. So they've got an
yeah,
Assassin's Creed coming.
I also
Just
want to
for
point out a couple different other things. Also, look at Disney. They have a crap ton of IP. They've already experimented over the last couple of years with, you know, like SquareSoft with like Kingdom Hearts. Not to mention their Disney Interactive division is friggin' huge. It's in the same building as where Disney Streaming is in Glendale. They have a lot of IPs that they're already like leveraging. Like for instance, I'm not sure if anyone plays Sea of Thieves. They're licensing out their IP for what was it, Pirates of the Caribbean, and recently some of their LucasArts IP with the Secret of Monkey Island title. So they got a lot of stuff that they could like leverage on, and they just got to pivot. But for the current moment, I think it's just that it's about operational costs recently that was taking a hit, and then just general fatigue of the current market, I guess, is my take. But long term overall, I think Disney's gonna be fine. Like that's my 2 cents. The only thing that might be a short term factor is the things that are happening with the strikes right now, and how fast they could restart production with some of the stuff that was already in the pipeline. Funny enough, I'm just gonna throw this out. If anyone is still an AMC holder, dude, I feel so bad for you because even if they did restart production, or like the strikes literally ended today, it would literally take maybe 3 to 6 months to redo a lot of the pre-production, the permits, the locations, and making sure that the actors are even open to shoot unless they're contractually obligated to shoot a different thing depending on what other people agree to. Then you got to do another 2 to 3 months of principal photography. Then depending on like how labor intensive or the VFX intensive or post intensive a movie is, a post production of a movie can take anywhere between a month to a whole year or two, depending on like how crazy it could be. And then there's like the marketing and distribution and like all that other stuff that happens behind the scenes for a single movie too. And the only thing that might be a a tailwind for movies is a lot of like the more indie stuff that might be coming out the next couple of years. So I think like something like A24 will be killing it. But luckily Disney themselves has a what was it, like the more indie part of their division from Fox that they received which was Searchlight Pictures, which did very well the last couple of years if I remember correctly.
Okay. Well, look, it's almost a quarter after. I was going to wrap at 6, so I think I'm going to take the moment then to just wrap this up. You know, I'm sure somebody will start a subsequent space that folks can trickle into, but really appreciate everyone joining into this afternoon's discussion. Just to kind of recap, we do these weekly at 4 o'clock on Fridays under this @Wook Capital handle, so be sure to throw it a follow. And also on Wednesday nights, I host just open mics with Joe, where we kind of talk about pretty much similar stuff that we're talking about today. So whatever folks want to talk about, we do that at 7 o'clock on Wednesday nights. And yeah, appreciate people tuning in. You know, I really enjoyed hearing some of the back and forths and different perspectives, especially some of the folks who have industry insights. I mean, that's the whole point of this, to echo kind of what Monative, I think, said the other day in the defense space. We're doing this to improve our own quality of thinking and hopefully come up with different ideas and perspectives that we otherwise might not get exposed to in our own little circle. So I think this platform continues to be a good tool for broadening exposure to different ideas and perspectives. If you're interested in chatting via text, we have, of course, the GME DD Discord server. You can type wook.gg into your URL and join the conversation there. And yeah, we had our book club. We do a monthly book club series. We covered Nassim Taleb's Fooled by Randomness Tuesday night. So Joe, I don't know if you uploaded that to our channel yet, but if you could just share anything that I missed, and we'll call it a night.
Yeah, so the book club hasn't been posted to YouTube just yet. Expect to see that pretty soon. We tried it on Discord for the first time. For this month, I think we'd like to try Discord again, but should we change that, we'll make it publicly known on Twitter. So yeah, sign up for the newsletter. Links in the Wook Capital Twitter bio, and you'll get all the updates there as well.
All right, great. Well, Bill, Monative, Chapman, Sick, Joe, and Lily, and anyone who I missed, appreciate you coming up and speaking, and look forward to talking with all of you again sometime soon. So have a nice weekend, everybody. Cheers.
Thanks, Rod. Guys, have a good weekend.